In the autumn of 1987, a retired schoolteacher named Marion Voss walked into a small regional bank holding a single piece of paper that would change how she saw money forever. She had come to pay off her mortgage early, proud of the extra payments she had scraped together over 11 years. The loan officer looked at her statement, then looked at her, and said something she never forgot. He told her that paying it off early would actually cost her more than letting it run its full course. Marion assumed he had misspoken because everything she had ever been taught said the opposite was true. Debt was the enemy, and the faster you killed it, the richer you became. But the banker slid the amortization schedule across the desk and asked her to read the first 3 years, line by line. What she saw made her stomach turn. Nearly 80% of every payment she had made in those early years had gone toward interest, not principal. She had been paying for over a decade and had barely touched the actual amount she borrowed. This wasn't a mistake or an oversight on her part. It was the mathematical architecture of the loan itself, built and structured long before she ever signed her name. Marion left the bank that day without paying off anything, and instead spent the next 6 months teaching herself how amortization actually worked. What she uncovered wasn't a conspiracy in the dramatic sense, no secret meetings or hidden ledgers. It was something far more effective, a system so normalized that almost nobody questioned it. Banks don't make their profit primarily from the interest rate printed on your contract. They make it from the order in which that interest is collected. Every standard mortgage, every car loan, every long-term installment debt is front-loaded, meaning the earliest payments are almost entirely interest, while the principal barely moves. This structure isn't illegal, and it isn't even hidden, because the schedule is technically available to anyone who asks for it. But almost nobody asks, and almost nobody reads it, because the monthly payment stays the same from month 1 to month 360. That flat, unchanging number creates an illusion of steady progress, when in reality, the actual debt reduction accelerates only in the final years of the loan. Marion started calling this the silence of the schedule, because the bank never lies to you. It simply lets you assume. She began digging through old loan documents belonging to friends and neighbors, comparing structures across different lenders and different decades. The pattern repeated everywhere with almost eerie consistency. A 30-year mortgage at a modest interest rate could result in the borrower paying more than double the original loan amount by the time the final check cleared. Most borrowers never calculated this number because banks are not required to advertise the total lifetime cost in bold letters on the front page. They advertise the monthly payment instead, because a monthly payment feels manageable, even comforting, while a lifetime total feels alarming. Marion realized the entire lending industry was built around this single psychological trick, showing people what they could afford today while quietly obscuring what it would ultimately cost them tomorrow. It wasn't fraud because every number was technically disclosed somewhere in the paperwork. It was simply a system optimized for people not to look too closely. The deeper Marion researched, the more she noticed how this same principle extended far beyond mortgages into nearly every corner of consumer debt. Credit cards used a similar front-loading logic, except compressed into a much shorter and far more punishing timeline. Car loans stretched over longer terms not because vehicles lasted longer, but because longer terms meant more months of interest-heavy payments before principal ever moved. Even student loans, marketed as investments in a person's future, followed the identical amortization curve that had shocked her at the bank counter. She began to see the broader pattern as less about any single loan and more about an entire financial culture built on the assumption that people would trust the monthly number and never ask about the total. Marion wasn't naturally suspicious or cynical by nature. She had simply stumbled onto something that most financial education conveniently skipped. Schools taught children how to balance a checkbook, but rarely explained how compound interest worked against a borrower rather than for one. Financial literacy programs celebrated the discipline of saving, yet said almost nothing about the mechanics buried inside the debt millions of people carried every single day. This gap wasn't accidental, because an entire industry benefited from that silence continuing generation after generation. What Marion eventually discovered next would prove far more unsettling than the amortization schedule itself. It involved a pattern she found buried inside the fine print of extra payment policies, one that revealed exactly how much banks depended on borrowers never paying attention to timing. The fine print Marion found was tucked into a section most borrowers skipped entirely, labeled simply as Additional Payment Handling Procedures. It explained that any extra money sent beyond the required monthly amount would not automatically reduce the principal balance unless the borrower specifically instructed the bank to apply it that way. Without that instruction, the extra payment would instead be counted toward the next month's due date, effectively prepaying future interest rather than eliminating it. This meant a borrower could send extra money for years, feeling proud of their discipline, while the loan's true timeline barely shifted at all. Marion tested this theory by calling her own bank and requesting a breakdown of how her past extra payments had actually been applied. The representative on the phone confirmed exactly what she suspected. 3 years of additional payments had been quietly absorbed as advance interest rather than principal reduction. Nobody had explained this when she made those payments, and nothing on her monthly statement had clearly flagged the difference. The form to redirect extra payments toward principal existed, but it wasn't offered, it wasn't advertised, and it certainly wasn't mentioned during the original loan signing. Marion realized this wasn't a rare glitch limited to her personal bank, because when she asked around, she found the same policy embedded almost universally across major lending institutions. It wasn't written to deceive anyone outright, since technically every detail existed somewhere in the paperwork borrowers had signed. But it was written in language dense enough and buried deep enough that almost nobody outside the industry ever encountered it before signing. This was the second layer of what she now understood as a much larger architecture, one built not on lies, but on friction, complexity, and quiet defaults that favored the lender every single time. She started mapping out exactly how much this default setting cost the average borrower over the life of a typical mortgage. On a modest loan, redirecting extra payments correctly toward principal could shave nearly a decade off the repayment timeline. Left on autopilot instead, that same extra money simply extended the illusion of progress while barely denting the actual debt owed. The dollar difference wasn't small either, often amounting to many tens of thousands of dollars in interest that never needed to be paid at all. Marion began to understand why banks rarely explained this clearly during the loan process, because clarity here worked directly against their long-term interest income. Every borrower who understood how to properly direct extra payments became a borrower who would pay significantly less interest overall. Every borrower who remained unaware became, in effect, a much more profitable customer without ever realizing why. This wasn't a scandal that made headlines, because nothing about it was technically illegal or even unusual within the industry. It was simply the quiet, cumulative result of complexity working in favor of the party that designed the system in the first place. Marion decided to test one more thing before she felt confident sharing what she had learned, wanting to see whether this pattern held true across different types of debt beyond just mortgages. She examined a friend's older auto loan agreements next, looking very specifically for that same kind of default language around extra or early payments. Sure enough, the structure mirrored what she found at her own bank almost exactly, with early payments front-loaded toward interest and extra payments requiring specific instructions to touch principal directly. The consistency across completely different lenders and completely different loan types told her this wasn't coincidence or an isolated policy choice made by one careless institution. It was an industry-wide standard, refined over decades, that relied on borrower inattention as a quiet but reliable source of additional profit. Marion started keeping a small notebook where she recorded these findings, not out of anger, but out of genuine curiosity about how deeply this pattern extended. She interviewed a retired loan underwriter who had spent 30 years inside the industry, someone willing to speak candidly now that he no longer depended on the business for his income.
He confirmed what she suspected, explaining that amortization structures and payment application defaults were never designed with malicious intent in any single meeting or memo. Instead, they evolved gradually over generations of lending practice, each small design choice quietly favoring predictable revenue over borrower transparency, until the system simply became the unquestioned standard. What struck Marian most wasn't the existence of these mechanisms themselves, but how completely absent they were from any public conversation about personal finance.
Financial advice everywhere focused on cutting expenses, building better budgets, and increasing income, while almost nothing addressed the internal mechanics of the debt people already carried. She began to wonder how many families had spent decades making what felt like responsible extra payments, never realizing that a single form or phone call could have redirected that same money toward actually eliminating their debt faster. The gap between what people assumed about their loans and what was mathematically true beneath the surface represented, in her eyes, one of the largest unspoken transfers of wealth in ordinary financial life. It wasn't theft in any legal sense, and no single person could be blamed for orchestrating it. It was simply a system that rewarded silence, and Marian had finally learned how to break it. One quiet phone call and one redirected payment at a time. Marian's notebook eventually grew into something she never expected, filling with case studies and calculations that told the same story from a dozen different angles. What began as personal curiosity slowly turned into something she felt compelled to share, starting with her own adult children who were just beginning to take on mortgages of their own. She sat them down at her kitchen table and walked them through the same amortization schedule that had once shocked her at the bank counter years earlier. Her son resisted the idea at first, insisting that his loan officer would have mentioned something this important if it truly mattered. Marian simply handed him his own paperwork and asked him to calculate exactly how much of his first year's payments had gone toward principal. When he finished the math himself, his expression mirrored the same disbelief she had felt sitting in that borrowed office chair years before. He hadn't been lied to, not in any legal sense, but he also hadn't been told the full picture in language anyone without a finance degree could easily understand. Marian explained that the solution wasn't complicated once you knew what to look for, and it certainly wasn't about avoiding debt altogether. Debt itself wasn't really the villain in this whole story, because, used correctly, it remained one of the most powerful tools for building a stable financial life. The real issue was the information gap between what lenders were required to disclose and what borrowers actually understood well enough to act on. She taught her son 3 simple habits that could change the entire trajectory of any loan he would ever take out. First, always request written confirmation that extra payments are applied directly to principal rather than future interest. Second, calculate the total lifetime cost of any loan before signing, not just the monthly payment printed on the offer sheet. Third, revisit that calculation every few years, because refinancing or restructuring at the right moment could save tens of thousands of dollars that most people simply left on the table. None of these habits required insider knowledge. They only required someone willing to ask the right questions before signing anything. Marian began sharing this same conversation with neighbors, former colleagues, and eventually strangers who found her through word of mouth alone. She never charged anyone for her time, and she never positioned herself as some kind of financial guru. She simply repeated the same message using the same kitchen table honesty that had worked with her own children. Debt isn't dangerous because banks are evil, she would tell people. It's dangerous because complexity works against anyone who doesn't take the time to understand it. The people who built these lending systems weren't villains in a back room somewhere. They were simply optimizing a business model within rules that required disclosure but never required clarity. That distinction mattered enormously because it meant the solution wasn't outrage or distrust. It was education delivered in language people could actually use. Marian often compared it to reading a contract in a foreign language you technically had access to, but never learned to speak fluently. The words were all there on the page, available to anyone who looked, yet nearly invisible to anyone who hadn't been taught how to read them properly. This was the real lesson buried inside her entire journey, one that extended far beyond mortgages, credit cards, or auto loans into nearly every corner of modern financial life. Systems don't need to lie to benefit from silence. They simply need complexity dense enough that most people give up before asking the second or third question. Marian realized that financial literacy wasn't really about memorizing formulas or becoming an expert in economics. It was about building the confidence to ask uncomfortable questions in rooms where everyone expected you to simply nod and sign. It was about understanding that a monthly payment you could afford wasn't the same thing as a total cost you had actually agreed to pay. Years after that first conversation at the bank counter, Marian still remembered the loan officer's face when she asked for a full breakdown of her extra payment history. He hadn't expected the question because almost nobody asked it, and his hesitation told her how rarely borrowers pushed back. That hesitation became quiet proof of everything she had discovered, a small crack revealing how much depended on people simply not asking. Marian never grew angry at banks, understanding they operated within a framework that rewarded this quiet advantage. Instead, she grew determined to make sure the people she cared about never signed anything without understanding the true shape of what they were agreeing to. The story she always told wasn't about escaping debt entirely, because debt used wisely remained one of the greatest tools for building long-term financial stability. It was about refusing to let silence decide the terms of that debt, refusing to let a comfortable monthly number replace genuine understanding of the total cost being paid. What Marian Voss ultimately proved, quietly and without any dramatic confrontation, was that the biggest advantage in modern finance rarely belongs to the party with more money. It belongs to the party willing to ask one more question than everyone else in the room. The one question banks were never required to volunteer, but were always required to answer honestly the moment someone actually asked.